December 28th, 2024. Making the review, obviously, Saturday morning. And you can see to start the day, we got a big gap down. And just get rid of this stuff. Coming into the day, obviously, the prior day was more of a trading range, and we got a gap down below the prior day's low. And so the first thing that I like to look at when I get a gap down is, are we going to close the gap with the prior day's low? Because if we don't, that qualifies as one open gap. And if we get a second open gap, it's very possible that we're going a lot lower. We did obviously end up getting the second open gap, and we did not go down all day. I thought that this reversal up and that this reversal up might limit the downside on the day. And, I got too focused on this sell off and I kind of ignored the context over here. And I'll explain a couple of mistakes I made on this day a little later in the video. But certainly wasn't my best day today. I had a pretty bad day, but I don't think most of the trades that I took were terrible, but I think my management could have been a lot better. Bar one, a bear bar closing near its low. Good for the or on its low, basically. Good for the bears. Probably going at least a little bit lower. In general, when you get a big gap down, you're looking for a second leg down from the gap. So, and you're looking for it to not close the gap with the prior day's low. So I think that is where we're trying to get to for the bulls. The bulls want to get up here, and the bears want to prevent us from getting up here. And so long as they continue to prevent the bulls from getting a successful reversal, it's possible that we end up getting a collapse to the downside. Bar two, consecutive bear bars. We're probably going at least a little bit lower. Bar three, it's three straight bear bars, but there's a large tail on the top. So, how much lower are we going to go without a pullback? I don't know. But the first pullback is probably going to be minor because we have three straight bear bars. An outside up bar on bar four, it's good for the bulls, and bar four might need a second leg. But given the context of the big gap down and three straight bear bars, the first reversal up is probably going to be minor. Five, an inside bar, a bear bar closing near its low. It's a double top. So first leg down, pull back, double top, neckline, the bar four low. Bears want a breakout below the neckline, the bar four low, and a measured move down to at least here. Six consecutive bear bars. You could sell below five or below six. Your expectation is that you don't really want to get a bull bar, right? If you get a bull bar closing near its high, that's probably your sign to get out, considering the fact that we shouldn't get a bull bar if this trade is going to work. You're betting on bulls who were buying for any reason, getting traps, trying to get back to the close of bar four. So you can see on seven, we collapse to the downside. The bulls give up, and a lot of stops are run below four, and that causes the big bear bar on bar seven. Do you sell the close of seven? You probably can. You just have to have the correct expectation for the trade. If we get a big bull bar closing near its high, or even if a bar that was exactly like bar eight happened, but it closed on its high, it probably would be better to just exit the trade. The reason is that would increase the chances that bar seven is a trap. Whenever you get a bar like bar seven that's extremely climactic, your brain should automatically start to think, well, what if it's a trap? What if the next bar is a good looking bull bar? And if it is a good looking bull bar, you can just get out of the trade. Seven is obviously climactic, but there's not really much to buy so far on this day. So if you do take sell below seven, you really don't want the next bar to look the way that bar four looks. You want it to look, eight is okay because it's a doji bar, probably sellers above. But again, like I said, you really don't want this bar or this bar eight to look like a big bull bar closing your tie. You want it to be a more sideways bar. Nine, a bear bar. You could sell the close of nine. We're probably going at least a little bit lower, but the downside might be limited. 10 consecutive bear bars. Good for the bears. Again, probably going at least a little bit lower. Probably sellers above, scaling and higher. Probably buyers somewhere below. But 11, a bull bar, not able to close on its high or even able to close above its midpoint. So, your best follow through would have been if it closed in its lower third. Sorry, it closed on its midpoint, essentially. Let's see. Thought it closed below it. Oh, it closed on its midpoint. So that's not as great, right? You want a bar closing below its midpoint. Ideally, you want a bear bar, a bull bar closing in its lower third. Well, actually, ideally, you want a big bear bar, obviously, but if you're going to get a pullback, you want the pullback to be closing in its lower third. 12, an inside bar, a low one short, probably buyers below, scaling in lower. It's a third leg down. So 13, more follow through, but again, a third leg down, and we're pretty far from the moving average. So my first trade today that I took was I sold the close of nine and I sold more on the close of 11. And I ended up getting out. I got out way too high. I got out above 16. But I know that this 4-bar micro channel is a minor reversal. And I considered holding with a wider stop, but I just ended up getting out of the trade because, essentially I was hoping for a bear trend and for the reversal to be minor, and it was minor. I just think I could have probably managed it better, because the reality is my calibrated expectation, if I'm selling this close and I'm selling this close, is that we keep collapsing to the downside. And we started to not do that, which is why I exited the trade. Probably could have exited on the close of 15 or above 14 after 3 legs down. I was hoping the third leg would be a little more climactic and get somewhere down here so I could exit. But what's the problem? We have 6,000 here. 6,000 is obviously a big round number and obviously going to be support. You can see we kind of oscillated. We bounced off it a couple times, then it was resistance a couple times. So the market was obviously paying attention to 6,000 in this price area. 14, a bull bar, 3 legs down. So some traders will exit above 14. Consecutive bull bars, 15, a tail on the top, tail on the bottom. 16, 3 straight bull bars, large tails on the top and on the bottom as well. Again, we're probably going at least a little bit higher. We're probably going to get at least a small second leg sideways to up. 17, another bull bar. So 14, 15, 16, and 17, 4 straight bull closes, expecting us to go at least a little bit higher, but how much higher? This is the most recent lower high, and this is another lower high, essentially on a lower time frame, right? Spike, pullback, possible bear channel. So probably limited to this area if we even go above this area. So if we rally a little bit more, this would be resistance. So not really great to buy the close of 17. If anything, it's probably better to sell the close of 17. 18, a bear bar, buyers below 17, probably willing to scale in lower. And then 19, a large bear bar closing near its low. Do you sell below 19? I don't know. I think if I sold below 19, my problem would be that 14, 15, 16, and 17 exist. If you're selling below 19, you're hoping for a breakout below the wedge. 1, pullback, 2, pullback, 3. So if you're taking the short and you're looking for a breakout below a wedge, and you just had 4 straight bull bars, what are the odds that that trade is going to work? Probably not all that high. What are the odds that it's going to work if you don't get immediate follow through? Again, probably not all that great. And your risk is relatively big because your stop is above 17 if you're selling below 19. So if I'm taking this short below 19, I want 20 to look like 19. I want to get swept into a big swing trade. And instead, I get a doji bar on bar 20. So I'm probably pretty disappointed in bar 20 if I had sold below 19, because this is in a delicate area, possibly bottom of the trading range in the rally to 17. Those bulls are currently trapped, but you need them to get trapped in a way that, they probably feel trapped with 18 and 19, but 20 is more reassurance for the bulls. And when we start to turn up, they probably don't feel as trapped. They're probably more looking to add. You want another big bear bar completely trapping these bulls into this trade and making them exit at a loss. And you don't really get that. Instead, you get a doji bar on 20, bears exit, and that causes 21 to bounce above 20. And then an outside down bar 21, second leg trap. An inside bar 22, an IOI pattern, really just a possible final flag. And it just shows me really that we're probably going to get a second leg up from 14 to 17. 23, consecutive bull bars, but a tail on the top, probably sellers above, probably buyers below. 24, a huge bull bar, good for the bulls. This gap is open, and gaps usually close on trading range days, so we might have to get back up into this area. This is pretty strong selling, but with how much buying there is in here and in here, this is looking like an area of agreement. When you have an area of agreement, it's difficult for the market to get far away from it. And so that's why, these shorts, these sell-offs, as good as they look, they're probably minor reversals, because we're probably going to come back to this area of agreement. I say it's an area of agreement because we got a large bull, large bull spike, a deep pullback, another large bull spike. So to me, it shows the bulls are willing to buy in here, and they're probably scaling in lower. So if you're going to be short in this area, you're probably hoping for a small pullback bear trend, and you're looking for small pullback bear trend price action. And you're not looking to sit through 3-legged pullbacks. And so, while it's not, with the system that I'm trading where you sell, close, and you hold, while it's not awful to just hold and then get out somewhere up in here, ideally, I think I would get out above 41. I think I got out over here somewhere. So I took a small loss here. But I think that getting out over here makes more sense given the fact that this is an area of agreement. We should get back into it, especially like the midpoint, right? So you got to be watching the midpoint. This type of area, it's probably going to be a magnet. So that's why I think had I, it probably would have been better to exit quicker. So I also bar 25, essentially a high one, because it's a pullback on a lower time frame. So if you're buying above 25, what do you want to see? You want 26 to be a big bull bar. If you're buying up here, you're trying to get swept into, basically a rally directly up to the bar 4 low. And if you're buying above here, where would your stop be? I did buy above that just to take a chance that this was a big bull bar. 26 was a big bull bar. Why? Why did I buy it? It's not the best buy. Well, it's low probability. You can just put your stop below here and bet on this gap closing and try to get 3-1, which is why it's low probability. After this surprise, you should get a second leg. So you're hoping that your second leg is going to start here and be a big bull bar closing near its high. So I wanted 26 to look probably something like 17 or a bigger version of 17. And instead I got a bear bar. I should have just exited below 26. I ended up just letting myself get stopped out, but I should have exited below 26. And I could also sell below 26 because I know that the bulls who are long for any reason are disappointed in 26. This is not what they wanted to see. They wanted to see a bull bar closing near its high. Therefore, since I know the bulls are disappointed with 26, it's a valid sell below 26. Or you could wait for follow through. 27 consecutive bear bars. You could sell below 27, trying to get a measured move. 28, 3 straight bear bars, 3-bar micro channel. It's probably going at least a little bit lower. 29, a bear surprise. Good for the bears. Probably going to get a pullback, but again, expect to go at least a little bit lower. An inside bar on 30, probably buyers, maybe somewhere below scaling and lower, but we're clearly always in short. Did we ever flip to clearly always in long? I don't really think so. I think that we got enough to make me think that we're not going that much lower, but I don't think any of these rallies clearly flip the market to always in long. You're trying to buy essentially, an always in flip if you're buying any of those bars, and you need to be quick to get out because bulls pretty much have, on 18 they need, or 17 they need one more bar. On 24, 25 they need one more good looking bull bar. 31, an inside bar, a low one short, probably buyers below, scaling and lower. 32, a bear bar. If you sold below 31, 32 isn't great with the large tail, but we're probably still going lower. An inside bar, a low one short, good for the bears, but there's large tails on these bars and it's a late leg. So what are the odds that you're going to sell 33, 34, 35 and probably just get a collapse? I don't know. Not really all that great. I think, 60% chance that you get a second leg from the sell off to 35, but there's doji bars, lots of overlap. It's a late leg. So that's why it's probably, probably a lot closer to 60, if anything. Probably like 60% chance you get another leg down. But you can see we traded above the top of the leg, the 31 high, before you even got the second leg. So the pullback can be obviously disappointing in this. 36, a bull bar, but a large tail on the top. And then 37, a bounce up to the bar, 31 high. On a smaller time frame, I'm sure this is a two-legged correction. Up on 36, down on 36, up on 37, and then some sort of low too short down on 37, back to the new low. So I'm sure somewhere in here, there's a two-legged correction and then a dip back down to this area. 38, a big bear bar. It's a second leg. It's a second leg down for the bears. From 1, pull back 2, or you could argue third leg 1, pull back 2, pull back 3. The tail is disappointing. I think you don't want to see a big tail on 38. However, if this trade is going to work and if we are going to get a breakout below and get to the measured move of 26 through 29, we're probably going to start to get good looking bear bars here pretty soon. I think that 38 should be a bear bar closing on or near its low. And since it's not, 39 should probably be a bear bar closing on or near its low. And instead you get a bull bar. That's pretty disappointing. Double bottom, 36, 39. Probably buyers below, scaling and lower. And again, like I said, if you were shorting, you wanted a small pullback bear trend. You wanted the market to move like a small pullback bear trend. And it's not. It's really moving more like a trading range. And if this is a trading range, we're probably low in the trading range. And you know where the area of agreement is. I mentioned it earlier. So you have to be wondering if we're going to get back into that area. 40, disappointment. Like I said, buyers below. And then 41, a bull bar closing on its high. It's a midday reversal and a good looking bull bar. I think it probably makes sense to get out. Above 41, bulls can buy, but not really. Only one closed above the moving average so far today. So I'm not really that keen on buying above 41. 42, consecutive bull bars. Good for the bulls, probably going at least a little bit higher. 43, big, small, big pattern. So probably buyers below 43 for a second leg up, but you're expecting a pullback after the big, small, big pattern. 45, an inside bar, probably sellers above, scaling in higher. 46, another bull bar, back to around the 43 close. And then 47, an inside bar, again, probably sellers above, scaling in higher because it's an inside bar and a high one buy, but it's still overall a bull trend. So the traders who are selling above are probably scalping for minor reversals, probably traders buying below 47. An outside bar, 48, it is a couple legs up. So 49, you could be looking at as third leg up, first leg to 43, second leg to 47, and third leg 49. But if you're looking at it like that, well, first off, that would be the bear argument, the way to look at it. But you could also look at it as midday reversal. We might need to test back up towards the top of that that area of agreement, or maybe that bar 8 high. And so bulls who are buying above 50 think that it's a tight bull channel and that it's not a bear trend. And this isn't three legs up in a trading range. We're probably going to get a couple more legs up in the trading range. We have an open gap here, which is important, with the 40 high and the 42 low. Think about it. If you're a bear and you sold above 40, you probably think you're going to be able to scale in and make money, right? It's pretty standard to think that if you sell above here, you'll have a way to get out and make money. And you can see those traders got stuck and it never got back to that price. It just continued up, obviously, until this sell-off. But I think it was important that these bears got trapped. 49, a doji bar, or sorry, 50, a doji bar, 51, a good-looking bull bar. Probably still going higher. Again, 3-bar microchannel, pullback. 3 bars, pullback. 3 bars, pullback. So it seems like after 3 bull bars, we keep getting pullbacks. 52, buyers below 51, expecting a second leg up. And then 53, big bull bar. You can buy the close, break out above a bull channel, 3 legs up, possibly part of a tight bull channel. But you're buying the middle of a trading range after a bear move down. And, I had a similar day like this that I was trading a practice day, and it basically did the same thing where you had a bear move down, more of a sideways move, but this day and that day I did pretty poorly on. So this seems to be this type of day where you get a bear channel and then go somewhat sideways the remainder of the day. It seems to be a weakness of mine. 54, follow through for the buyers above 53, buyers below 54 during 55, tight bull channel. 56, 57, 58, 3 more bull bars. If you're buying the close of 58, you're hoping that we're just going to basically break out above the tight bull channel. You're buying a late leg, so you have to understand if you're buying up here, you got to be quick to get out. And you can see traders more willing to buy below 58 than they were to buy above 58, which shows you that this is probably more sideways. 60, a bear bar, probably buyers below, and then outside up 61, a bull bar closing on its high. You could buy above 61, taking a chance that we're basically going to start a rally above the bull channel. Pretty late in the bull channel to just be buying closes. So if you're buying, you're hoping we get a breakout above, basically a climactic move up to here. 61, follow through, 62, follow through, 63, more follow through. So 3 straight bull bars. You can buy these closes. My last trade today was I did buy the close of 64 since it was a 4-bar micro channel, but it's a late leg, right? So it's really, late leg here, disappointing. Late leg here, probably disappointing unless you get really fast follow through. 65, an inside bar, a high 1, and then we traded above 66. It's okay to buy above the high 1 in the bull trend, but you need good follow through. And you initially got it on 66, but then disappointment 67. It's okay to be thinking we're going to get a tight bull channel up to this area until we get 67. For me, I think I should have just exited below 67, considering that if we're going to get a bounce, we're probably just traders going to buy the close of 67 and we're going to get a big bull bar. Instead, we go below. Disappointing doji 68, traders exit, and that causes the big sell-off 69. An inside bar 70, a low 1, probably buyers below for a scalp, but you can see they bought below and they scalped out, and then we get a second leg down. This is big enough for a second leg down, and then a bit of a buy the close finish. 76 needs a second leg, so some traders would buy above 76, taking a chance that, remember, this whole thing on a higher time frame is a breakout. So it probably needs a second leg. Right. So this is going to need a second leg, right? It's pretty clear. So this pullback just looks like a 2-legged pullback on a higher time frame. So this, you have to realize, is probably a minor reversal against the tight bull channel. For stop orders today, probably you could sell below 5, 7, higher probability. I don't know. There was a lot of potential stop orders. You just had to have patience and discipline, or in a lot of them, you had to be quick to get out, I suppose. That would be the discipline part. 26, 27, 28, 29, sell the close. Second leg down, probably exit 41. 41, aggressive buy, probably better 47 or 49. 53, you could buy below the bull bars, obviously 43, 47, and then 51 or 54. 58, traders buying below bars, not above them. And then you could buy above 61, 62, 63, 64, and then obviously probably get out below 68. It's tough to sell below 68, but you probably could. And that probably is it on the day for the daily chart. As you can see, big down, big up, confusion, right? We might go down a little further. Some traders might sell the close of this bar, betting the second leg is going to get below this low, but this also needs a second leg. looks like the range is contracting. Maybe we form a triangle over the next, I don't know, over January, the end of December and January. The weekly chart, obviously, that's not a great bull bar. IOI pattern, which is a breakout mode pattern. So probably the 50-50 chance the first reversal fails. So I'm going to pay attention to last week's low and high next week. And then the monthly chart, there's only 2 or 3 trading days left in the month, but the close of this bar is important. If we get a bull close, it's follow through for the bulls. Either way, it's not super bullish because even if we get the follow through, they probably still need more to convince traders we're going a lot higher. But if it's a bear close, bulls might look to exit. All right, that is going to be it.